All right. Welcome, everybody. It is Wednesday, and we are coming to you live with Investing Education Academy. Today, we have a topic that many of you all might not even know to be aware of. It's called SPACs. And we're going to talk about what a SPAC is, why you should know about a SPAC, and why it's important to you as you invest. While Leon gives you the rundown why we chose this today, I'm going to do a little bit of housekeeping.
Yeah, so last week we covered, our topic was IPO report card, right? And we identified, we pointed out that 431 IPOs had happened through last week. And that's a lot. Like that's a lot of IPOs. I'm not sure where it stands historically, but that's a lot of IPOs in 1 year. And a big reason why that's happening, this year, is because of this new form of IPO that's called a SPAC. And SPAC is spelled S-P-A-C. SPAC, S-P-A-C. And the SPACs are interesting because we have a slide, so Brent, we get a chance, you could throw up slide one. But SPACs are interesting because they do something that, so a lot of people know the process for going public, right? So the way it works is companies, they do what's called a roadshow. And a roadshow is where companies literally, well, before COVID, they would literally go on the road, fly around different cities all around the country and pitch this IPO to hedge funds, pension funds, mutual funds, family offices, just people that have money to buy some shares. And these road shows were time consuming. A lot of founders, especially startups, can't stand them because they got to schmooze with all these people and they got to, kiss some tails, for lack of a better term, to really get people to buy into their IPO. And it's also expensive. IPOs are generally expensive. There are a lot of fees that companies pay to underwriters to facilitate an IPO. So an IPO, again, the way it works is they do these road shows. And then what a lot of people don't realize is when we as the public buy the shares in the public market, the IPO has already happened. It happened the day before. So when all these big companies buy these shares, when they go on this roadshow and buy these shares, that's the IPO. So like typically on the day of an IPO, when we see it come out, they'll say, "Oh, the company raised $500 million." And it used to confuse me because I'm like, how they raise $500 million and the IPO is just happening today? Well, the IPO actually happens the day before it lists on the market. That money is raised by the companies when they do this roadshow, and then they sell the shares to the public, sell it to us. So anybody that gets it on the actual IPO that happens the day before, they get it at huge discounts. Then when it becomes public, as we saw with Airbnb and DoorDash and C3.ai, they get these instant, 100, 200% jumps, and they make an absolute killing because they bought the shares, for pennies on the dollar at times. Next thing they'll be 80, 90 bucks. So that's the process of an IPO. So what a SPAC is, SPACs kind of eliminate all that, but they have a really, really interesting way that it actually works. And to me, like when I read about it, when I first reading about these, I was like, this sounds almost fraudulent, but it's not. So, all right, we have the slide one up. And as I said, SPAC stands for Special Purpose Acquisition Company. And that's what SPAC stands for, and pronounced SPAC. And what's interesting is, so as point two says, so what a SPAC does, the way it works is, if let's say Brent and I were to start a SPAC, right? We would actually go out, do a quote unquote, do a roadshow. We would raise, however, let's say $300 million. And then we would list the shares of our company. But our company, that company actually has no business, right? It has no business, has no revenue, it has no business model, has none of it. All a SPAC is a shell company that goes public to raise money and then eventually will buy up either a startup or maybe buy up another public company. But the whole point of a SPAC is for that company for that shell company to raise money and then go out and buy another company. So as it says in point three, SPAC's sole purpose is to raise money through an IPO, then use those funds to acquire another company, right? So that's all a SPAC is. SPAC is just a shell company that goes public. And to me, when I first read about this, I was like, that sounds fraudulent. Like you go public just to raise money, but you have no business, right? Just sound weird. But so the laws behind SPACs are that when the money is raised, it has to then go into an interest-bearing account that can only be touched when either they're acquiring another company or they're returning the money to the shareholders. So it can't be like hoarded or stolen or anything. It goes into basically a lockbox until that acquisition of that company that they want to buy happens.
Yeah, and it's similar to the way it works. If any of you all have done business with law firms, you might know this. Their money goes into trust, and until activity is done, they actually can't cash out. Some of these SPACs, though, they can. When you invest in them, your money does exist somewhere, and it allows for, I guess, the retail investor to have an opportunity where sometimes we don't.
Yeah, right. Because I mean, it's so and so what happens is, so like when somebody does a SPAC, and typically SPACs are done by individuals, right? They're not typically done by companies. They're typically done by like people that own hedge funds, or like heads of mutual funds that they're kind of doing on the side. It's kind of like basically like a side hustle for rich people. But when they do the SPAC, they tell their investors, okay, this is usually the focus at a particular industry, right? So they'll say, okay, we're looking to do our SPAC, and we're looking to buy like a database company or an AI company. Like the investors know beforehand the sector or industry they're going to go into, but they have no idea who they're going to buy at the time. And another term for SPAC is what they call blank check companies, because essentially the investors are just writing essentially a blank check to this individual because they have no idea where their money's going. So, well, they know where it's going. They don't know the type of company it's going to buy into. So SPACs, you may also hear the term blank check company. So that's how SPAC. Go ahead.
When people put their money into these type of setups, normally it comes on the reputation of the individual or very small company that's setting up the account. Mm-hmm. So sometimes you're not really investing in the company because you don't know what it's going to be, but you're investing in the person who's running that fund or that account.
Yep. Yeah. They're usually headed by well-known VCs, investors, former heads of big companies. Like they're well-known people. So, like I said, if Brent and I started a SPAC, we would probably get not too far. It's really like I said. I'm just saying. I mean, based on what we just said, the definition of who runs SPACs, we're not hedge fund owners, we're not former heads of major companies. So just saying. Just kind of giving a relative analogy.
Yeah, we can agree to disagree.
So, all right. Next point is that so SPACs have been huge. So like I said, 50 have happened this year, and that's 50 out of the 431 IPOs that have happened. That's a pretty big percentage. So so last year SPACs raised $13.6 billion with a B, and this year just through August, 50 SPACs have raised $21.5 billion. That's a 60% increase from last year. So that shows how popular SPACs have become. And the benefit to us, last point, the benefit to us is that this makes it easier for small companies to come public, right? So they don't have to worry about going on a roadshow. They don't have to worry about paying a lot of the fees that come with an IPO. They can just basically reverse merge with a current shell company and then go public. So it benefits us really, really well because it brings a lot more companies public.
Yeah, and also too, one of the things you want to think about with these SPACs, there are more being done, but there are also more IPOs. We're talking about $85 billion a year for IPOs. So this is also respectively a very big year for IPOs. So when you look at the fact that SPACs are raised 21 billion, just know there's also it's a different kind of marketplace this year. Everything has had new rules this year. So I do believe that as people become more familiar with SPACs, the comfort level, the market is always forward looking. And as long as people get information, they understand where their money is, people are always going to look for alternative ways to grow their money. So I definitely think there's going to be space for these SPACs to acquire more market position.
And an example of a SPAC is a company that a lot of us know. So last year, a company, and a lot of times, if you're ever looking like online and researching stocks, if you see something that says like XYZ acquisition, and that's all it says for the name, like the name doesn't really pertain to what it does, that's most likely a SPAC. A lot of them have acquisition at the end of their name. So an example is a pretty well-known company that all of us know. So last year, a company called Diamond Eagle Acquisition went public. They raised $350 million for their SPAC. And then this year, Diamond Eagle Acquisition merged with a company called DraftKings. And that's how DraftKings became public. DraftKings is probably the most famous SPAC out there right now. And that happened, I believe, in April of this year. So just after COVID had hit, they merged with Diamond Eagle Acquisition. one of the most famous SPACs to come public now is DraftKings. And actually, DraftKings was one of our picks a few weeks ago too.
Yeah, I think DraftKings is up probably 20% or more since we picked it.
Yeah. Oh yeah. DraftKings up. I mean, since it's come public, it's up huge. And yeah, since we picked it, it's up, 20, between 20 and 30%.
So these SPACs will actually have a definite impact on you as an investor, which is why we want to bring this information to you all, because some people just aren't familiar with them or how they work. And we wouldn't want you to see it and run the other way, because although it's kind of a new concept for some people, it's a very, time-tested platform for others. And I mean, time-tested that they've been in 1 or 2, 3, 4, 5 of them. So we've been involved with DraftKings. We actually made the purchase of DraftKings, and it was one of our picks. So we definitely are familiar with it.
Mm-hmm. And if you ever see a company that, for instance, the one that merged with the SPAC that merged with DraftKings was called Diamond Eagle Acquisition. If you ever see a company like that with the term acquisition at the end, make sure you do. I mean, we always say do your research, but make sure you do your research into that company, because you want to be familiar with what type of SPAC they are. Are they doing biotech? Are they doing tech? Are they doing energy? Are they doing in a sector that's just really beat down right now? You want to really know who they're merging with, because you want to make sure your money is going in a place where, because remember, if you buy, because you can buy these SPACs before they merge. Like you could have bought Diamond Eagle Acquisition before it merged with DraftKings. It became DraftKings. So if you ever see one of these SPACs, you make sure you do your research, because I mean, you can theoretically get in early before the merger, before the SPAC deal goes through. So that could be kind of a strategy, but you just want to make sure you know what this SPAC is doing, where they're going to put this money that they raised.
Yeah, and also for you all who think, oh, this is alternative to being an accredited investor, it's not. It's another way to get in before the IPO, yes, but it doesn't take the place for being able to get into some of the bigger companies that go the traditional route of an IPO. You still have to be an accredited investor to get into those particular investments.
Yeah, and this isn't going in before the IPO. The IPO already happened because the acquisition company has already done the IPO. They're just now merging with the private company, which then inherently brings that private company public, and then you get the company like DraftKings. So yeah, as Brent said, there's no this isn't like a backdoor thing that you're going to get in on some sweet deal. But had somebody bought Diamond Eagle Acquisition when they came public, last year, they'd be doing really well right now, because DraftKings is up huge. And before the SPAC deal went through, nobody knew they were going to merge with DraftKings. So like I said, just do your homework if you're looking at some SPACs. They're definitely interesting plays, and there are a ton of them coming out between this year and even next year. So the takeaways, just wrap up. A SPAC is just basically a public shell company looking to merge with another company. And again, typically that company they're going to merge with is going to be a private company. It's rare you see SPAC deals that happen that you have one public company, which is a SPAC, that then merges with another public company that's already trading. So it's typically going to bring public a company like a private company like DraftKings. SPACs help speed the IPO process for private companies, which helps us out because that brings more deals to the table for us. And probably the most famous SPAC deal so far has been DraftKings. Again, they merged with Diamond Eagle Acquisition in April of this year.
And before we go to the last one, I want to say, for those of you, and this is not one of our picks, we will give you our picks in just a very short moment. But anybody who's looking at DraftKings like, oh, I missed the IPO, it's over. It's still, I mean, that company still has a long way to go. So it's still a good buy for me. Just want to put that out there. Not suggesting you go buy it, do your research. But for anybody watching this who thinks, oh man, I missed the boat on DraftKings, you have not.
Nah, because DraftKings just came public in April, so it hadn't even been public a year yet. So I mean, like I always said, the three things that make money will typically always make money are things to do with gambling, making people money, or things around sex. So those three, and DraftKings being a gambling site, things that people wait for people to make money. I think it'll definitely be fine. I wish FanDuel would go public, but they're actually owned by I believe a private equity company that's not looking to spin them off just yet. I would imagine they're waiting for
situations where it behooves people to be, accredited investors. That the rules just change in that space.
Oh yeah. If you're an accredited investor, you can get into a lot of these deals before they go public. But I'd imagine the FanDuel people are waiting to see for DraftKings to be out, see kind of what their valuation is, and then when they look to go public, they can then base their valuation on what DraftKings is trading at.
Yeah, but I mean, basically, it's gonna be proof of concept.
Yeah, right. Yep. And they know what the valuation will be then. Because one thing that's going on right now. So just real quick for everyone to know. So next year there's a company called Affirm and a company called Roblox that are going public, and they've actually rescheduled their IPOs. They were supposed to be this year, but they rescheduled their IPOs because of what happened with DoorDash and Airbnb. Because remember what I said. IPOs happened the day before, right? So and those companies, let's just use Airbnb. Airbnb basically doubled when it came out, when it came public. What that means is the market. So what that means is the market was willing to pay more for the IPO than it was priced. It was priced at 68, and it came out at like 100 something. So what that means is Airbnb, when they did their IPO the day before, underbid themselves. They could have raised that IPO price to well over $100, and they didn't. And so they basically lost out on money because remember the IPO happens the day before. So when they priced it at 68, that was the price that everyone got who bought it the day before. When it came public, the market showed that it could sustain a price well above $100. So they left a lot of money on the table. So now Roblox and what did I say? Affirm, I think it's called. They actually delayed their IPOs because the pricing mechanism right now for IPOs is way out of whack.
Yeah.
So the thing's kind of on pause till early next year.
And that's kind of what happened with Snowflake, right? Snowflake
Yeah,
almost went under, and then they came back like the day before and went from what was it, like $75-$80 and went up to 120.
Well, it was supposed to come out at like I think like 40 or 50. It priced at
they increased the price 3 times, but then they did a price increase the day before, which normally doesn't happen.
Right. Yeah. Yep.
So it's because they knew money would be left on the table if they didn't. And I know some of you all are like, wondering some of these companies. We'll talk about them later. And I know those with kids probably know about Roblox, but it's going to be interesting to see how this IPO plays out.
Yeah, I mean the fact that Snowflake raised their price the day before, they saw that huge demand, and even when they did that, their stock price still popped. Now it didn't pop as much as Airbnb because Airbnb basically doubled, which shows that Airbnb was way mispriced. So now Roblox and I believe it's Affirm have postponed their IPOs till next year to kind of tighten up that whole price discovery thing for IPOs. And the last point is so there's actually an ETF that tracks these SPACs, and it was really interesting when I was reading about doing the research on this, and we're going to profile that ETF, and we're going to talk about the ETF and then the companies that they track within our membership at www.iamembers.com. So all members, IEA members, look out for that.
Yep, and for everybody who's watching, we have our first intern who will be joining IEA in the next day or two. So this is going to be really exciting. You all will see her probably on one of these lives, actually taking over for Leon and I. So we're going to have some fun with this. We're growing, and we're working towards creating a scholarship for kids to get membership to Investing Education Academy, because it's really important for us to get this to our young people before they go into the marketplace and just make mistakes. So, or just avoid the marketplace altogether because they just don't know it. So more information will come, and we're excited to announce that. But for everybody who showed us support and allowed us to get to this place where we can bring on interns and create scholarships, we definitely thank you all. To Kayla Solinsky, and I hope I said that right, who is assisting us in creating the award/scholarship from Macbeth Academy. We really appreciate you. Everybody, please check out Macbeth Academy. It's a private school. They have lower, middle, and upper levels, and it's also all private. And they're setting the school up to be a feeder to Ivy League colleges. So, there's a lot of good things happening in IEA. We just want to kind of let you all know about that. And we're going to have some fun things happening going to the new year. There's going to be maybe some membership, wink, wink, opportunities for you all. There might be some giveaways. There's going to be some maybe contests inside of our IEA members platform. We're still figuring it out, but there's going to be some cool things happening going towards the end of the year and then launching in January. And we've checked these stats. and checked our database, and we have heard you all say that some of you all would like to have a sit down with Leon and I. So we're going to figure out what that can look like. If we're going to do either a workshop where we just have an open workshop and anybody who is in or out of the IA community can participate, or if we're going to do private sessions for people who are inside the community, where we actually go through their portfolios individually with them one-on-one to kind of see what they have. So a lot of good stuff happening, but now we owe you all picks. So let's see.
So you and me first.
I go first.
All right.
So I chose Good RX. Pull it out. The ticker symbol is GDRX. The company helps you find medicine at lower cost. So they have a huge database where they can search, sometimes globally, to find the cheapest medicine for you to actually purchase. Then you can take a certificate or a coupon to a respective pharmacy and actually give it to them, and you'll get the whatever the medicine is at the cheapest price. So their business model is amazing when you think about the fact that medicine is running our world, and we have an aging population of over 72 trillion people, about to be roughly like 100 million people. That's a big number. 72 million right now, going to 100 million. And they recently IPO'd in September, I believe it was. Let's see. It was September. Was it September, Leon?
Yeah, I think so, because it was relatively recent. So yeah, maybe right. It was a few months ago.
Yeah. They created so much of a buzz that Amazon then released their Amazon, I believe it's called Amazon Drugs. And the really cool part about that is the fact that they won't directly hurt GoodRx's platform because they're trying to do delivery services. GoodRx is trying to find best pricing and send it out to individuals. And if anybody watches Mad Money or Jim Cramer, you will know Jim Cramer is a huge fan of this company. He's been a supporter since they started. And they had their spike in the 70s, but now they're at about 42, which I think makes them just a great purchase price to see what the future is going to be for this company.
I must say it's a perfect example of this backs up the data we showed that IPOs typically have a big spike and they come back down to earth and they'll kind of trend higher. So looking at that chart, yeah, that thing went, it basically almost doubled from the IPO and then, came back below 40 and then now it's, kind of trending higher.
Yeah, the top they hit was like 71, I want to say, at the high. And yeah, you got to think this company has roughly a $16 billion market cap. So it's not a small company. And on top of that, as they grow and get more footing, they're getting corporate backing by providing this service to some employees at large corporations, which is just going to be guaranteed money for them. So I'm really liking, how they're structuring themselves. The CEO is aggressive, and I think it's going to be a great play for where our society is heading.
Yep. All right, cool. So my pick is a company called CyberArk. Ticker, I didn't write it down. What is the ticker symbol?
I got it. Got it.
Okay, so the ticker symbol is
CyberArk is CYBR. Anybody listening to the podcast or watching, the ticker symbol is CYBR.
Yeah, so they're the name said they're a cybersecurity company, but what's different about them is they focus on what's called privileged accounts, and those are people that are essentially behind the firewall, right? So most cybersecurity companies are trying to prevent people from getting breaking into a company. They focus basically on employees who are already working at the company who could be a risk, because a lot of things happen. A lot of espionage things can happen from within a company too. So they actually help secure people that are privileged, again, people that are behind the firewall that typically work for the company or contractors, and then help lock down or kind of scale their privileges, their permissions within a company. So it's CyberArk, and there's a few stats. Their revenue over the last 3 years on average is growing at 26%, and their profits are growing on average the last 3 years of 57%. So remember, we always say that a typical growth company grows their profits at about 20-25%, and CyberArk is more than doubling that. So my pick is CyberArk. ticker symbol CYBR.
All right. So again, today, if you're listening to the podcast, if you're watching us live, one of the picks is CyberArk Software. The ticker symbol is CYBR. It's roughly trading at $119.28. And let's take a look. The other is GoodRx Holdings. Ticker symbol is GDRX. It is trading at $42.45. So, it's kind of, I just want to point this out. Nobody asked, and it's a little extra bit. But if you notice the PE ratios on both of these companies, it's through the roof. And this is a testament to how companies now are operating. I just thought it'd be interesting to point that out. This has a PE ratio of 818. And so CyberArk has a PE ratio of 1,698. This is a completely new way of investing. And for anybody who's watching this, just a quick history. One of the big things with the whole 1929 stock market crash was these companies were trading at the extremely high PE ratios. But the difference between then and now was many of the people who were buying these companies were leveraged. They were leveraged through the roof, and the thought was no company could ever go down. This is not really the same way anymore, because number one, it's not everybody in the world trading on margin, because margin was new in the 20s. But these PE ratios didn't exist, not to be this high. This is something very recent, and I'm curious where the market's going to go, where the industry as a whole is going to go with accepting PE ratios that are this high.
Yeah, I think that, and for anybody who's unaware, so PE ratios are just a way to value a company. The lower the PE ratio, the cheaper the company is. The higher the PE ratio, the higher, more expensive the company is. So the companies that Brent and I just showed today are, on average, expensive companies. What does that mean? Well, that it's as Brent said, we're kind of in uncharted territories, because what's happening right now is with especially tech companies, PE ratios are high for a reason, because you're paying for future growth. So your PE ratio is telling you that the market is saying, okay, we're expecting this company to grow huge in the next, whatever years, 3-5 years. Companies that have low PE ratios that are the average PE ratio right now for the S&P 500 is about 20 to 25. So the PE ratio of the companies we have are huge, right? And what that means is the market is saying that they expect these companies to grow huge in the future. They may not grow huge in the future. They may not meet that goal. And in the next 1 or 2 years, if they don't start growing to kind of to justify those PEs, they could turn over in price, or they may not. We have no idea. That's just what the market is. But I always go back to say I would trade based on fundamentals. My two biggest, the ones I always quote, are revenues and sales, because that's ultimately what companies are in business for, to bring in money to then to earn money, and revenues and sales project that. Are they expensive? Yes. By the PE standard, yes, they are. Does that mean they'll go down? I have no idea. Nobody. we just don't.
Yeah, this is new. You got to think too. You go back to Warren Buffett style. I think he tried to get companies that had PE ratios below 12. And
yeah.
So that world just doesn't exist like it did before. So this is kind of, I hate to say it, it's kind of the new normal, but the market is forward looking, and the market will penalize a company if it's not catching. Well, it might. If the company isn't catching up to what the PE ratio is stating the future growth should be. There could be some type of correction in the pricing, or you might see the company change, the way it runs its business, business overhead expense. That goes into a whole lot of other things. But it's something you all should know. This is a conversation Leon and I would normally have behind closed doors, so I just wanted to talk about it because you guys get a peek into what we talk about when the camera's not on. So it's I thought it'd just be fun just to bring it up before we left. But still, they're both good companies. I expect good things from both of them. And our goal is to introduce you to companies that you may otherwise not have been watching.
Right. Just one last point on PE. If you look at Brett, you pull up Zoom.
Yeah.
Because Zoom's PE, I think, is pretty ridiculous too. And we're not saying this to like downplay PE, because we use PE.
They're 200. They were. Yeah. It was if you would have looked at Zoom in January of this year, it might have been somewhere in the 500 to 600 range.
Yeah, it was a lot higher. 200 is crazy high too. But it was like double that before. But think about it. Zoom's PE is 281. The stock is up, I don't know, 300 or 400% this year.
Yeah.
So, and that's what we always said. PEs are good ways to value companies, but they're not the end all be all, right? You still kind of have to have like an intuitive nature of kind of how the market's moving. Technology runs everything. We're right now in COVID. So these data points, they can't be the end all be all. They're just kind of one factor in your decision making. And I mean, I know for me, for tech, PE ratios don't weigh that much. Or actually, if I'm looking at a tech company and their PE ratio is low, to me, that's actually a red flag, because that means the market doesn't project this company's going to grow as much as a company like Zoom or like GoodRx.
Mm-hmm. So everybody, please take that with entertainment value, if you will, but it's true, you know, and you always have to do your research, you know, in addition to looking at the financials. I love looking at management, like, you know, what's their position on growth? Are they aggressive? Are they passive? You know, are there any potential acquisitions on the table? You know, all these things help me understand what the plan is. Like CRM, when we named we thought CRM was a good buy, the CEO is buying up companies like crazy. And I mean, their whole model right now is acquisition based, which could put them in a heck of a lot of debt later on. But we think it's going to be good. We think they're going to do well, but you still have to watch these companies. So we're not just guessing. We understand how the company is planning on growing, and we're watching it. And just for fun, let me pull up CRMs. They probably have a crazy, and they probably do have something that's going to be sick.
And CRM is in the process of buying Slack right now.
Oh no, their PE ratio is 58.
Ooh, that's wow. Okay, that's actually.
So that means they're making money.
Yeah, I was about to say, relatively speaking, that's low. I mean, that's still high compared to the market, but relative to technology, that's low. But yeah, again, that means they're making money, definitely.
Yeah. So, you know, and you're like, why did you say it means they're making money? Normally, when these PE ratios are really high, it's because they think the growth is going to come in the future. So the market hasn't really caught up on how they're going to price or what the PE ratio should be now, because they're just looking at all future growth. Once they have an understanding, like they have a feel for where the company is, what the financials are, the PE ratios tend to balance out a little bit more. This still historically is high. I don't think this is high anymore. It's historically high, but I don't think it's high now.
No, yeah, for tech, no, that's not high at all.
So, you know, this is, again, just conversations we would normally have behind closed doors. A little bit of a bonus for everybody to know how we think, what we look at. And for anybody who is now thinking, oh, you know, I actually would love to have more of these conversations, you can join us at www.ieamembers.com. I had a number of people call me because I recently took the hot seat for IEA, and Leon asked me some very technical questions that I wasn't anticipating. So it was a fun time, but you got to see my portfolio. You got a chance to see the stocks that I own. You got a chance to see how much I've made, the percentage return, the dollar amounts. You got to see a lot. I mean, if you are an IA and you're an insider or a Panther, you got to see my actual portfolio. And I received a number of phone calls and texts about that. So I believe people enjoyed it, and Leon did not hold back. So we have to make sure we get Leon in his hot seat pretty soon, because I need.
Well, it sounds like a little payback coming.
Yeah, oh my gosh, revenge. I'm writing down questions, doing research. No, it was fun though. Everybody, it was a really fun conversation. And you know, I hope you get a chance to watch it. The replay is in ieamembers.com. You can still see my account, you can still see my picks. And one, I did two of my accounts. One is from 7 years ago, and one is from 2 years ago. So you can see how the different accounts behaved. And you also can see the different returns in one that's 2 years old versus one that is 7 years old. So it was definitely a good time.
Definitely.
All right, everybody, thank you so much for being with us. We will be back next Wednesday. You're going to see our intern. I'm not sure how we're going to pull her into this, but it's going to be fun to see with a millennial. She's a senior at Spelman College, so we're super excited about that. And we're also doing some shoe. We're getting into the shoe game. We told you all it's now moving forward.
Sneaker.
And we're doing that. What'd you say, Lee?
Sneaker, because people get confused with shoes.
Sneaker flipping. So IA is getting into sneaker flipping. And our consultant for that is going to be Roderick Williams, who is a senior at Morehouse College. So we are going to be representing ATL pretty heavy over the next year or so. So all good things, all positive territory, and we will see you all next week.